Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. In this video, we're revealing my 3 favorite stocks for 2021. Got 2020 behind us, and now I'm thinking about what are my 3 favorite stocks that I'm going to be buying next year. Now, I don't think it's a great idea to just be buying, a little bit of shares here and a little bit of shares there, because as far as diversification goes, yeah, you want a diversified portfolio and a bunch of different stocks. But once you get up to 50 or 100 or 200 stocks, you kind of have that diminishing returns. And Warren Buffett said something like about why put money into your 10th best idea. So I'm only picking 3 stocks for the year, and with a couple others on standby. And I want to put about $4,000 into each stock, because then it would fit my position sizing for my overall portfolio. So if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, and document my own journey towards financial independence. So if you learn anything in this video or get any value out of it, I really appreciate it. A little thumbs up and subscribe to the channel if you haven't already. All right. Okay, so first stock we're going to talk about is Home Depot. We all know Home Depot. You go there to buy 2x4s and hammers and stuff like that. Currently trading about $267, has a market cap of $286 billion, and has a yield of 2.26%. The dividend is, you might consider it a little low, but it has a high growth rate, a low payout ratio, and it's been growing its dividend for 20% a year for the past 5 years, and consecutively growing its dividend for 11 years. And performance-wise, if you would have invested $1,000 into Home Depot 10 years ago, you would have averaged 25% a year, and your money would be worth $9,700 today. Home Depot has been doing strong financially. It's grown its revenue from $88 billion a year to $110 billion a year. That's up 25% in the past 5 years. And net income has gone from $7 billion up to $11.2 billion. And that's a 60% increase in net income. Next company we have is ADP, Automatic Data Processing. And what they do is they process payments. They're a payment processor. So your employer will have all their HR information and your payroll stuff with ADP. And your employer will send the money to ADP. Then ADP will write your check, send the appropriate taxes to Social Security and Medicare, and your little FICA taxes, and sort out all that stuff. And then your retirement contributions, they'll send that to your retirement people, the people that run your retirement account. And they're currently trading at $167, and also a low yield of 2.2%. Kind of same idea as Home Depot, where they have a lower yield, but they still have a low payout ratio, but a high growth rate. They've been increasing their dividend 12.85% for the past 5 years. They've been growing their dividend for 22 years. And they've been averaging a return of 18% a year for the past 10 years. In 2016, their revenue was $11 billion, but they increased that to $14 billion in 2020. They raised it by 24%. And then net income is $1.4 billion, or about 1.5 in 2016, and increased that to $2.4 billion in 2020, a 65% increase. And what's cool about these two companies is the revenue's increasing, but the profitability is increasing even more. ADP delivers payroll to 22 million workers. That's 1 in every 6 workers in the United States. And it's partnered up with 7,000 tax agencies, and it moves $2.2 trillion in payroll and taxes in fiscal year 2020. And what's kind of cool about that is all this money that gets passed through ADP. They can take this money and they can invest it for a short time, like, a couple days or whatever, in treasury bonds, and they'll get just a little smidgen of interest off of that, putting that money in a savings or into gaining interest off these accounts. And a little bit of money for a little bit of time isn't very much, but when you're processing $2.2 trillion, that actually adds up to a lot of extra revenue that you get by processing all this money. They also have this thing called the ADP Employment Report, where they have so many customers and they're putting out so many payroll checks. They know, they have a good idea of how many people are employed in the United States. And then they report this once a month to kind of keep track of the economy. And it holds a lot of weight. And you'll see that this ADP report will be, they'll show it on CNBC when it has good news or bad news or what it's saying about the economy. Last, we have JP Morgan. The biggest bank in the United States, and it's one of the biggest banks in the world. Right now, $131, and has a, yield is about the same as the others, 2.8%, and has a low payout ratio of 47%, and it's been growing its dividend about 16% over the past 5 years, and growing it for the past 10 years. Oh, one thing though with JP Morgan is that it's like one of those important financial institutions, so the Federal Reserve has a lot of say in if JP Morgan can increase dividends and buy back shares and stuff like that. And back in, was it like April, when the Federal Reserve did their stress tests, Wells Fargo had to cut their dividend. JP Morgan did fine. They were not allowed to buy back shares, but they still had, their balance sheet was strong enough where they did not have to cut their dividend. And just recently, they had new stress tests come out, and JP Morgan is allowed to buy back shares again, and they started a new $30 billion share buyback program. JP Morgan has averaged 14% return for the past 10 years. On the income statement side, revenue has increased from $89 billion in 2015 to $110 billion in 2019, increasing by 23%. Net income increased from $24 billion to $36 billion, increasing 49%. Now, the reason JP Morgan outperformed something like Wells Fargo is because JP Morgan is a lot more aimed at high net worth clients. They have a lot of asset management and commercial investment banking stuff, a lot more than Wells Fargo. And Wells Fargo is more aimed at your average, your average people, your average consumer. And those are the people that got hit the hardest with COVID-19 financially. And JP Morgan, they're kind of broken up into 4 sections. Consumer banking, which is your average stuff, your average checking account and credit cards and stuff like that. That's down from the third quarter of this year versus last year. Consumer banking net income is down 9%. Corporate and investment banking is up year over year, 52%. Commercial banking is up 15%. And wealth management is up 31% year over year, third quarter versus third quarter last year. Hopefully I can add about $4,000 into each company. That would make me really happy, and my channel is almost monetized, so I think that would help a lot. And I have a couple other ideas on how to get some extra money this year. But we'll see how that goes. I think that's all I got for this video. Hope you like it. Give me a thumbs up if you learn anything. Give me a little comment down below if you agree on these 3 companies. And subscribe to my channel if you haven't, alright? Because I'm putting out videos as much as I can right now. Yep. And then I'll put some other cool videos over here that we can watch. And I want you to go have a good day, alright? Justin out.